afternoon, ladies and gentlemen. My name is Jason at AustCham Korea here in Seoul. And as we kickstart the new year, it is my pleasure to welcome you to today's exciting webinar update on key tax law amendments for 2022. Today, we'll be joined by 4 tax expert speakers from Lee & Co sharing insights into the subjects, which will be divided into 2 topics. First, the discussion of key tax law changes for 2022, and secondly, OECD developments on global corporate tax reform and impact in Korea. The presentation will be followed by a moderated Q&A session, so we encourage the audience to tune into the end for questions. Now, without further ado, it is my great pleasure to welcome Mr. Kwon for introduction.
Thank you for the kind introduction, Ms. Sun. It is a pleasure to present to you today, and we are grateful for the opportunity provided to us. Before we jump into topic 1, I would also like to take this opportunity to introduce the speakers today, all of whom have many years' experience working on complex Korean tax matters. First, my name is Kwon, and I'm a tax partner and senior foreign legal counsel, specializing in international tax. I have almost 20 years work experience working in both the US and in Korea. To my immediate left is Steve O. Steve O is also a partner and US attorney specializing in both inbound and outbound Korean tax matters and has over 10 years work experience in both the US and in Korea. Next to Steve is also Steve Kim. Steve Kim is a specialist in transfer pricing and international tax. Finally, I would also like to introduce Mr. Jung-hong Kim. Mr. Kim recently joined Lee & Co's tax practice, specializing in international tax and tax treaty interpretation. Prior to coming to Lee & Co, Mr. Kim had an illustrious career with the Ministry of Economy and Finance in charge of international tax, Supreme Court of Korea, as well as the OECD Korea Tax Center. You can read our full bios on the Lee & Co website. Now, without further ado, we will start topic 1, the summary of key tax law changes for 2022. Myself, Steve O, and Steve Kim will present this topic. In July of last year, the MOEF announced the government's tax amendment proposals for 2022. According to the MOEF, the Ministry of Economy and Finance, the amendments were intended to encourage economic recovery from COVID-19, increase fiscal support and drive the growth of industry sectors that will boom in the post-COVID era, reduce the economic inequality that has worsened, and improve anti-avoidance measures. These proposals have generally been enacted into law without significant changes as of this month, January 20, 2022. We will briefly summarize some of the key amendments that could impact foreign investors and companies doing business in Korea. Please note that separate from these tax law changes, the proposed revisions to the related presidential decrees, which are the Korean tax regulations, were published earlier this month. It is expected that these changes to the presidential decrees will come into effect in the 3rd quarter of this year. The first topic I would like to discuss is the extension of the flat tax rates for foreign nationals working in Korea. Generally, foreigners who are Korean tax residents are subject to regular individual income tax at the standard rates. The rates are graduated from 6.6% up to 49.5%, which includes surtax. However, there is a special elective flat tax regime for foreigners who are employed in Korea for the first 5 years of their employment. In addition, under a separate tax incentive regime, certain qualified engineers, researchers, and specialists can claim a special tax exemption for 50% up to 70% of their Korean earned income in the first 5 years of employment. The amendments extend both of these elections to December 31, 2023. In other words, foreign nationals who start working in Korea from now to the end of 2023 can make this election, which will become effective for 5 years. Separately, many foreigners are aware that they may be required, to report foreign financial account information to the NTS if they are Korean tax residents. However, the amendments will extend the scope of reporting and disclosure requirements to now also include foreign real estate. So a foreigner who is a Korean resident may need to disclose both real estate held overseas, in addition to information on their bank accounts and brokerage accounts held overseas. The next amendment I would like to discuss is tax credits. Like many other countries, Korea provides tax credits for certain costs such as R&D, facilities investment, and for the creation of jobs. A tax credit is the amount that a taxpayer is permitted to subtract from the tax payable owed to the tax authority. Therefore, tax credits are generally viewed by taxpayers as more favorable than tax deductions. The amendments increase tax credits for R&D costs, investments in facilities, and human resources related to certain designated industries highlighted as national strategic technology. These include semiconductors, car batteries, and vaccine development and production. This is expected to apply to R&D costs incurred, investments in facilities, and jobs created between July 1, 2021 through December 31, 2024. The amendment also introduces enhanced R&D tax credit mechanism for certain other designated high-tech industries, but which are below the level of national strategic technology. These include green industries and biotech. The next amendment relates to beneficial ownership requirements for foreign funds. Generally, under the Korean domestic tax law, a foreign fund called an overseas investment vehicle, or OIV, should be disregarded and looked to for tax purposes. And the investors in the OIV would be viewed as the beneficial owners of the Korean source account. However, in certain prescribed cases, the OIV itself can be viewed as the beneficial owner. The amendments clarify that the OIV can be viewed as the beneficial owner in the following cases. One, the OIV should be viewed as the resident of the jurisdiction where it is established. Two, the OIV should be recognized as the beneficial owner under the tax treaty and also be eligible for tax treaty benefits. Or three, the OIV is unable to substantiate or disclose its investors. This amendment will be important for foreign funds going forward that invest into Korea, as historically there was a great deal of controversy and disputes regarding when a fund can be viewed as the beneficial owner of Korean income, as opposed to the investors of the fund. This amendment should clarify this issue, providing certainty to fund investors. Amendments also make certain changes to the Korean VAT compliance obligation rules, some of which are substantial. Some of the major changes include the following. Taxpayer will be granted additional time to issue an amended VAT invoice up to 1 year after the VAT return is filed. Taxpayer will be granted additional time to claim input VAT refund. Foreign businesses without a business place or permanent establishment in Korea that provide electronic services under the so-called digital VAT compliance regime will now be required to prepare and maintain more detailed documentation related to supply of electronic services. Excuse me. And finally, as part of customs clearance, there will be an increase in the scope of cases where the importer of record will be permitted to amend the import VAT invoice. The import VAT invoice is important since it is required to claim the input VAT tax refund. Now I would like to turn over to my colleague, Steve O, who will discuss some of the other amendments. Thank you.
Thank you, Tom. And again, thanks to the Australian Chamber of Commerce for having me here. throughout the years of staggering economy, we see this ongoing trend of the rigid tax reporting regime where taxing authorities seek more information than ever. This slide is a good example of it. To give you a little bit of the background, we have experienced since 2014 reporting on foreign account and assets for both corporate and individual taxpayers. We've also seen some of corporate taxpayers struggle with these reporting obligations when the scope of reporting was expanded to include the accounts of their 100% owned foreign subsidiaries. These foreign account reporting requirement is particularly relevant if you have on payroll an Australian expat working here for a long time and became a Korean resident for tax purposes. For expatriates, there is an exempt status if they stayed here less than 5 years for the last 10-year period. So this is a sort of a bright line test based on a physical presence. So unless otherwise exempted, you would want to make sure whether you have become a resident subject to this reporting. Just so you know, the threshold amount is 500 million Korean won. That's about, I guess, 580,000 Australian dollars. As to this amendment, it's not on financial accounts, but on your real estate properties. I mean, this has been subject to reporting from day one, but the rule was when you acquire or sell or renting out the property, and then you would have to report. This revision tries to fix, I would say, the technical glitch where people who acquired the asset before 2014 and held it and never rented out, which you were technically out of the scope of this reporting. But not anymore with this revision, whether you lease or not, the ownership of foreign real estate properties should be reflected in your tax return. The second subject of this slide is additional reporting requirement if you have a liaison office here in Korea. Technically, liaison office in Korea is not a taxable entity. It shall not be engaged in any trade or business or any revenue generating activities. So what they could do here is very limited, like researching, collecting information, and etc. For those what we call preparatory auxiliary type of work. This amendment is purely seeking information, but we've seen many times liaison office engaging in more than what they are allowed to do, inadvertently turns into a potential permanent establishment, which becomes a disproportionately difficult defense work dealing with the tax offices, as the test heavily relies on facts and circumstances, and not to mention that we need to go through a proper transfer pricing studies, the calculations of a profit attributable to such PE, and etc. So we should be careful and double check when we report the details on the liaison office, making sure we unnecessarily increase unintended tax exposure resulting from this reporting. Moving on to the next slide, we have changes to CFC regime. CFC rule is, one of the anti-avoidance regimes that most jurisdictions have. Basically, it prevents a deferral of certain offshore income parked in a jurisdiction that imposes low tax or no tax at all. So in determining where the low taxing jurisdiction is, Korea is one of few countries that uses a flat tax rate, which is a 15% effective tax rate as the the threshold, whereas most of the other jurisdictions, the rate is synced with the highest corporate income tax rate. So whenever the headline tax rate changes, that entails the change of the threshold rate to determine what low taxing jurisdiction should be, which I think it makes sense. So a quick takeaway for the changes in the CFC rule is that the threshold rate now has increased from 15 to about 19%. So if you have a CFC income and have relied on a so-called this high tax exception, then it is the right time to revisit to make sure that the jurisdiction is still eligible for this exception. Moving on to next, it's a new limitation on deduction of NOL. We have a general rule on NOL limitation, which is 15 years carry forward and no carry back. And not all the losses can be used for a current year, but up to 60% in general. This rule puts a further limit on the use of the tax attributes when business is acquired. So basically, you can use it against income from the other party when it is a related party transaction, and when the transferred business constitutes a significant portion of their business. So basically, you may not be able to offset the historic loss, and thus the acquiring company subject to this rule, therefore will need to maintain separate account to track down the availability of losses. The next slide is a new mechanism under which foreign tax credit may be achieved for funds. Most of the collective investment vehicle for outbound investment you would see are either trust fund or investment company type, regulated under Capital Markets Act in Korea. The commonality of these funds is that you rarely see these entities would pay an entity level tax. For investment trusts, they're not subject to tax by law. And for company type funds, they have special, the dividend deduction rule where, they wouldn't be subject to tax as long as they make distributions up to a certain extent. What's interesting in achieving foreign tax credit for these funds is that they make a refund request at the fund level up to 14% for foreign taxes paid, even though they are not subject to tax. But once they receive the fund, the money is taken into account for distribution towards the end investors. With this amendment going into 2023, along with the new financial investment income regime, the funds wouldn't seek foreign tax credits anymore at the fund level, but rather those foreign taxes, if any, will be credited to withholding taxes when the funds make distributions. This is for me for now, and why don't I turn the microphone over to Steve Kim, who is our transfer pricing subject matter expert. Steve.
Thank you, Steve. So my name is Steve Kim, and I will cover transfer pricing piece of today's webinar. And I hope my session works as time for all of you who spared your precious time in the midst of your busy schedule. The phrase "keeping at arm's length distance" has been spoken and heard more than ever in the COVID era. And as much as it's spoken and heard in our daily life, this particular phrase in transfer pricing context is also getting a larger spotlight, thanks to the looming unprecedented changes in international tax and transfer pricing. So as you know, transfer pricing has always been a headache for many multinational corporations because of its complexity and the significant amount at stake. So I'm going to start off by briefly introducing Korea's TPO regulatory regime for those of you who are not familiar with it. As most of you already know, Korea has been a member of OECD since 1996, and ever since then, the Korean government made due effort to keep pace with the OECD's international tax and transfer pricing development by codifying the OECD's mandate into its own TP regulatory regime. However, unlike Australia, where OECD TP guidance is explicitly referred to under its Income Tax Assessment Act, Korean TP regulation does not explicitly make reference to OECD's TP guidance. Instead, Korean government tried to timely reflect the key component of the OECD's new development and update into its own TP regulation. The year 2022 is not an exception. Korean government had lots of homework to do since year 2020, as there have been quite significant development and update in OECD's transfer pricing network. Particularly, OECD's TP guidance on COVID-19 and financial transactions are the major ones. So there are two prongs. Sorry about that. So there are two prongs. In 2020 TP amendment in Korea, first prong has to do with TP guidance on the COVID-19 pandemic, and the other prong is related to the TP financial, the financial TP guidance of the OECD. So let's get to it one by one. So the first point on my slide, first slide, is Korean government codified into the Korean TP regulation, a part of the chapter 2-2 of the OECD TP guidance of COVID, which provide valuable insight on losses and allocation of the exceptional and non-recurring costs incurred due to the COVID. To give you a long and short of it, now starting from tax assessment in 2022 and onwards, loss-making companies could possibly be included in comparable companies for benchmarking purpose when they are deemed comparable enough in light of function risk and asset profile of the test party. And this is because excluding them spontaneously without no solid reason will simply bias the benchmarking result in a COVID era. So what's the implication here? At the end of the day, this will highlight the importance of industry analysis and TP documentation for, as the impact of the COVID-19 may vary across the different industry, and it was even boon to some industry like e-commerce and online-based businesses, such as OTT platforms. It sounds like a cliche, and we can't really deny the fact that in many TP documentation so far in the market, the industry analysis was just prepared for the sake of the formality reasons, without any significant implication in transfer pricing analysis. Having said that, because of the COVID-19 impact and potential allowance of using loss-making companies as comparables, if appropriate, it is particularly important and critical to properly gauge the impact of such extraordinary situation in light of the industry classification of your company, as well as any company-specific risks. There is another qualification, just a second, the bullet on this slide, which is it has to do with the transfer pricing implication of COVID-19 pandemic. So as you may be already familiar with, CCA, or cost contribution arrangement, or sometimes it's called the CSA in the States, which is cost sharing agreement, is the arrangement where members of the MAD share the cost of developing intangible asset based on the level of expected benefit of respective participant and share economic ownership of such developed intangible asset. So what's the deal here? So in line of the chapter 2-6 of the guidance, Korean government proposed the exception to this arm's contribution under CCA arrangement, where the force majeure event prevent the allocation of the cost in accordance with the cost-sharing agreement made among the members of the MAD. Of course, having the force majeure provision in the contract in and of itself is not sufficient to invoke this particular rule, simply because always devil's in the detail. Like I said, whether COVID-19 pandemic constitute a force majeure event in the first place, or something along those lines, really depends on the industry we're dealing with, and more thorough analysis should accompany the underpinning the argument, especially in times of the past, that the pandemic was a real game changer in a negative way for certain taxpayers and certain disabilities. So moving on to the next page. So let's shift the gear and talk about TP guidance on financial transactions. So third point on this slide is related to the intragroup loan pricing. This is a very common issue facing multinational corporations. And Korean government's 2020 amendment was made in an effort to update this sort of kind of incomplete and outdated intercompany loan pricing regulation under its period, I would say. Before this amendment, there were no concrete methodologies that taxpayers could comply with or count on when it comes to intragroup loan pricing. The only recourse that taxpayer had before this amendment was to count on Korea's safe harbor rate for both inbound and outbound loan transactions. But this safer harbor rule per se, which is outdated as well, because it does not reflect that economic condition we're in, such as a low interest era. We're dealing with and transitioning away the LIBOR-based benchmark rate. Its current safe harbor rate for outbound loan is 460 bps, which is a ridiculous high. On the flip side, for Korean companies borrowing funds from the overseas affiliate, the applicable safe harbor rate is 1 year LIBOR plus 150 bps spread. We expect this safer harbor rate will be updated in the near future in such a way to reflect the current economic condition and transition away from current benchmark rate, which is based on LIBOR. Now, with this new amendment kicking in, the taxpayers in Korea have more legit options available in intragroup loan pricing. There are two detailed methodologies adopted by Korean government from OECD financial guidance. First one is to allow the use of credit default swap spread as a proxy for risk premium, which is akin to financial guarantee fee concept. And the second one is to allow the use of economic model based on risk-free rate plus risk premium. Of course, these methodologies have been well known and broadly applied among many TP practitioners as well as taxing authorities in many different jurisdictions. But the most important implication here is that now there is a clear legal basis in Korea, often which taxpayer can rely on when it comes to the TP compliance. And the clear legal basis based on this, tax authority can make their TP assessment. Also, one important implication for multinational companies having footprint both in both Korea and Australia is that by virtue of Korean government adopting part of the 2022 TP guidance on financial transaction, or remaining part of the guidance may also be referred to by Korean banking authorities. And some famous cases, such as Chevron case in Australia, ruling of which is pretty consistent with the 2020 TP guidance on financial transaction, may elicit more attention on Korean taxing authorities and TP practitioners in Korea, even though it is not a binding authority. The fourth point on the slide has bearing on cash pooling arrangement, which is quite commonly observed among many multinational corporations these days. This is quite a technical area, but I'll try to put it in a layman's term as much as I can. For those of you who are not really familiar with the concept of cash pooling, it is a liquidity-driven arrangement within a multinational corporation where the balance on the number of separate accounts of this group constituent in different jurisdictions are brought together, either physically or notionally, in an effort to reduce external borrowings or earn an enhanced return when there is cash surplus. For example, one common structure is where a participating member of the multinational corporation concluded a contract with an unrelated independent financial institution that renders cash pooling services, and each participating member open a bank account with that bank coordinator. So in the amendment, it defined the concept of cash pooling, which is not that common among Korean multinationals, but in anticipation of extended use of this cash pooling going forward, Korean government has adopted the cash pooling provision under its own future regulation by reference to the OECD's financial guidance in order to secure and broaden its own taxing plans. In addition to the definition, new cash pooling provision under the Korean future rule prescribes two different types of cash pooling, namely physical and notional one, and it also stipulates how cash pool litter each participant in pool should be remunerated. Basically, under the notional cash pooling, we look at net balances across all accounts of its constituent without physical transfer of funds, and bank providing such service charges interest on its net balance globally, which make the lower effective overall interest charge Generally speaking, under this notion of cash pooling, the cash pool leader's function is highly limited. And as external banks provide all cash pool services, such as offsetting balance sheets, one another without need for fund transfer. On the contrary, physical cash pooling, also known as zero balancing, requires physical transfer of cash balances between account, and bank charges interest based on the net balance remaining in cash pool leader's account. Because physical cash pool entails the actual transfer, an intercompany loan relationship is created between the participant and leader, and under which some participant becomes leader lenders, whereas others become borrower, depending on the credit position. So moving on to the third page, the most critical things under the cash pooling arrangement is how to remunerate those cash poolers. Just in line with how OECD's guideline, the new amendment provides two-step approach. We start with the cash pool leader's remuneration. That's a first step. In general, cash pool leader's function is limited to its coordinating an agency function, especially under the notion of cash pooling, and therefore its return should be highly limited as service provider. Once the cash pool leader's remuneration is determined, we go into the determination of remuneration for cash pool participant under step 2. Under the physical cash pooling, like I said earlier, as an intercompany loan relationship is created, an arm's length interest rate under the cash pooling arrangement should be calculated by taking into account the group synergy and realistic option available to group participants, meaning it is expected that all cash pool participants will be better off than in the absence of the cash pool arrangement. So more specifically, the amount of the group synergy benefit can be calculated by reference to the result that cash pool members would have obtained had they dealt solely with independent enterprises. So under the notion of cash pooling arrangement, however, since there is no underlying transaction through which the incremental group benefit generated from the cash pool can be allocated, benefit should be allocated based on the expected benefit of each participant in the form of some sort of interest expense saved or interest revenue incrementally earned. When engaging incremental benefit, enhanced interest rate, access to the permanent source of fund, reduced exposure to external banks, access to the liquidity should be taken into account. The last piece under the 2022 TP amendment is related to the Korean government's effort to induce taxpayers early compliance with BEPS Section 13 documentation. So currently, taxpayers will be imposed a non-compliance penalty of 30 million Korean won per report, which is local file, master file, and country by country reporting. So long as either these reports are not submitted by deadline, which is within 12 months from the end of each fiscal year, or the timely submitted report include intentional force or misleading information. However, after this amendment, depending on the timing of submission and or the correction after the deadline, taxpayers' burden of penalty could be significantly reduced in an effort to prompt taxpayers to comply with the requirement even after the deadline. That the penalty reduction scheme is set with a declining scale as shown in the table below. So basically, the longer the time left after the deadline, the lower deduction rate taxpayers will be eligible for. And the shorter the time left for the deadline, the higher the deduction rate taxpayers will be able to enjoy. So this is the end of my the slides, and I'll pass it back to Jay to pick up our second part of the webinar.
Thank you all for your informative presentation. It was great to learn about the changes happening in place. Building upon these insights, next up, I'm pleased to invite Mr. Jung-hong Kim, who will be speaking on the recent developments on global corporate tax reform and impact in Korea. Over to you, Mr. Kim.
Thank you, Ms. Song. Good afternoon, everyone. I'm grateful for this opportunity to share with you the recent developments on global tax reform. We used to call it digital tax, but it is not used anymore because the new tax is not targeted at purely IT giants such as GAFA. First, I need to mention a little about background. BEPS, which is Base Erosion and Profit Shifting Project of the OECD, started in 2013 in the aftermath of the global financial crisis in order to combat international tax avoidance of multinationals. Of the 15 BEPS actions, Action 1, taxation on digital economy, was the last remaining item to implement. It took more than 4 years for the international community to reach agreement on the two-pillar solution, which was welcomed by the G20 leaders at the end of October 2021. It would be fair to say that the negotiations are like year-by round of international taxation. Now, Pillar 1. This is basically about reallocation of taxing rights among markets on the super or excess profits of the world's largest multinationals. To be in scope, the M&A turnover threshold is over 20 billion euros, and 25% of the M&E's residual profit, which is the profit amount above 10%, will be allocated to each market country, regardless of the existence of a physical presence, that is, PE or subsidiaries. The extractive industry and regulated financial services are excluded. And technically, the amount of profit to be reallocated is called amount A. We continue with Pillar 1. For the nexus, market country threshold revenue will be over 1 billion euros for in-scope M&Es. For sourcing, the revenue will be sourced to the end market where goods or services are used or consumed. The tax base will be based on M&E financial accounting income with some adjustments. To enhance tax certainty, disputes will be resolved in a mandatory and binding manner. There will be a simplified rule for baseline marketing and distribution activities for market jurisdictions. This market allocated profit is called amount B. Unilateral measures such as digital services taxes will be abstained and removed once Pillar 1 is in effect. Now, Pillar 2. Pillar 2 is about introducing global minimum tax in order to neutralize the tax competition practices of low tax jurisdictions. The tax will apply to M&Es with an annual revenue of over 750 million euros, which is the same with BEPS Action 13 country by country reporting requirement. In this diagram on the right, operating subsidiary in country B shifts profits to a low tax jurisdiction down on the diagram, and with income inclusion rule, the low tax income will be additionally taxed to reach the minimum rate of 15% in country A, where the LB parent entity UPE is a resident, which is called a couple tax. When the income inclusion rule is not applied at the UPE level because A is also a low tax jurisdiction, then under tax payment rule kicks in which case country B would deny deduction or levy a couple tax on operating subsidiary. IIR and UTPR are not mandatory for countries, but once chosen, compliance with the rules are required. This is called common approach. The effective tax rate is to be calculated on a jurisdictional basis, which means if there are multiple subsidiaries in a country, the sum of taxes will be divided by the sum of tax bases. There are carve-outs for substance related to tangible assets and payrolls, and international shipping income will be excluded as well. Another prong of Pillar 2 is subject to tax rule, which is STPR, which allows the source country to impose limited taxation on payments, such as interest and royalties, if they are taxed below 9% in the payee's country. Now we are with global and local impacts. Globally, as mentioned earlier, Pillar 2 is basically about reallocation of taxing rights. Pillar 2, on the other hand, will lead to additional global tax revenue locally for Korea. Pillar 1 will likely affect Samsung and SK Hynix, and inbound foreign M&Es meeting the threshold will be subject to amount paid tax in Korea. For Pillar 2, local subsidiaries of foreign M&Es will not be subject to capital tax in parent jurisdictions because Korean effective tax rate will normally be over 15%. Some of you may remember that in December 2018, Korea abolished preferential tax regime for domestic companies with foreign capital in compliance with the EU Code of Conduct review. Then does the two-pillar solution mean the end of international tax avoidance and tax competition as we know? We have to look at how the detail will be practiced and implemented in the near future. Then next steps. Both pillars need to be elaborated in legal instruments, which are supposed to take effect in 2023. For each pillar, the ambitious timeline is scheduled for drafting, signing, and implementing the legal instruments such as model domestic rules, multilateral conventions, and commentaries. For Pillar 2, model rules for domestic legislation was published in December 2021. International tax experts have raised some doubts about the target deadline as they are too ambitious, as I said. Another concern is whether the US Congress will give a green light to the multilateral legal instrument reflecting the Pillar 1. So we will see what happens. With that, I would like to close my presentation.
Thank you for your presentation. It is very helpful to know not only on the Korean tax level amendment itself, but also on the global OECD level. Now we'll move on to the Q&A session. To start off, we have had some pre-submitted questions received from the audience. First off, what are the top 3 changes in Korean law that the Australian companies which are working with Korean companies may have issues or barriers in understanding or abiding by? And I believe that Mr. Jung-hong Kim, would you like to be able to answer this question?
Okay. I think there's no substantial change in or increase in tax compliance for foreign companies, including Australian companies, doing business in Korea in the recent tax amendment. But if I may, I would say there are 3 amendments that are worth noting, and 2 of which has been earlier covered by my colleagues, Tom and Steve. So the number 1, as you see in the slide, the reporting of liaison office in Korea of foreign enterprises. So amendment is under the Corporate Tax Act, and as Steve covered it already, I don't think I need to elaborate further, but I would rather, add one comment. The purpose is to prevent the disguise of the liaison office, which in substance may be regarded as a PE, and it means increased tax compliance for foreign enterprises doing business in Korea. Next. This is not covered in the previous slides, but I think it is important for Australian companies working as a distributor in Korea for Australian products imported. This is Customs Act in reinforcing penalties on M&E's reporting obligations. Currently, customs authorities may require multinationals to report customs valuation-related information, including details of the controlled import transaction. If they are not compliant or report wrong information, reporting order may be issued. If still not compliant, a penalty of up to 100 million won shall be levied. The amendment now requires up to 200 million won shall be levied as penalty. And my comment is the MNEs doing business, doing import businesses as distributors face reinforced reporting obligations for customs valuation purposes. It means that is not only an international tax issue, but customs as well. And the last remaining item is overseas business operators supplying inbound electronic services. This is under FED Act, and Tom has already covered it in his slide. So I would rather conclude with the last bullet point. This is basically for keeping track of overseas services to safeguard inbound VAT tax basis and revenue. Thank you.
To answer any of the questions through emails getting them back, we'll definitely reach out to audience if they have questions later on.
Yeah, or if the questions are sent to the chamber, and they, if you could forward it to us, then we would be certainly happy to provide a response.
Yeah, thank you. Well, we hope that today's event has helped your understanding in the tax law changes for facilitation of your business in Korea. Of course, also, if you have more questions, we'll be more than happy to connect you to Lee & Co. Once again, I would like to thank Lee & Co. partners for co-hosting today's presentation, and thank you all for your attending.
Thank you for
Thank you.
Thank you.